This is part 2 of the Chapter 4 lecture series on adjusting entries, specifically adjusting entries for deferrals. We will learn about the second type of adjusting entries in the next video. Let's get started. Before we learn about adjusting entries, let's look at the first 4 steps of the accounting cycle. Identify events that need to be recorded, and that is done throughout the period. Journalize these transactions in the general journal, which is also done throughout the period. Post them to the ledger, which again is done throughout the period. And then fourth, prepare a trial balance, which is done at the end of the period. This is where we left off in Chapter 3. So the question is, what now? We are at the end of the period. We have prepared the trial balance, which includes all of the accounts and the balance in each account. So you may think that we're ready to prepare financial statements. However, we aren't quite ready to prepare them. The reason we can't prepare financial statements yet is because some of the balances in the accounts are incorrect. So we must analyze the balance in each account per the trial balance and determine if they are correct. If a balance is not correct, then we must prepare an adjusting entry to correct it. This is the purpose of adjusting entries, to correct balances to ensure that the revenue and expense recognition principles are followed. Do you remember the purpose of general journal entries? That's right, to record accounting transactions. As I mentioned in Chapter 3, every type of journal entry has a purpose. Again, the purpose of adjusting entries is to correct balances. We should prepare adjusting entries at the end of every period prior to preparing financial statements. There are 3 helpful hints for preparing adjusting entries. First, each adjusting entry always involves only 2 accounts. You will only have 1 debit and only 1 credit. Second, each adjusting entry always involves 1 income statement account, meaning a revenue or an expense account, and 1 balance sheet account, an asset or a liability account. Third, adjusting entries never involve cash. As I mentioned in the intro video, there are 2 types of adjusting entries, deferrals and accruals. It's important to remember that the reason we have to prepare adjusting entries at all is because there is sometimes a timing difference between cash changing hands and the earning of a revenue or the incurrence of an expense. If we always received payment at the time of earning a revenue, and we always paid immediately when we incur an expense, there would be no need for adjusting entries. The first type of adjusting entries is deferrals. With deferrals, the cash exchange happens before the revenue is earned or the expense is incurred. Remember, the cash exchange happens first. The second type of adjusting entries is accruals. With accruals, the cash exchange happens after the revenue is earned or the expense is incurred. Remember, the cash exchange happens later. We will learn about deferrals in this video and accruals in the next video. There are 2 types of deferrals, prepaid expenses and unearned revenues. We talked about both of these types of accounts in Chapter 3. Now let's learn about the adjusting entries that are required because of them. Remember that a prepaid expense is an asset to a company. The company pays cash for something that will benefit multiple periods. The cash exchange happens before we incur the expense. Also remember that an unearned revenue is a liability to a company. The company receives cash for something that it hasn't done yet. The cash exchange happens before we earn the revenue. Now let's talk more in depth about prepaid expenses. Again, the company pays for something that will provide benefit in the future. When we make the payment, we record an asset because it will provide benefit in the future. We must prepare an adjusting entry at the end of the period to record the amount used or consumed during the period. The adjusting entry will always involve a debit or an increase to an expense account to recognize the expense incurred for the period, and a credit or decrease to an asset account to recognize the portion that is used up and will therefore no longer provide benefit. A common example is insurance. Insurance companies make their customers pay in advance. So when a company makes the payment, it would debit prepaid insurance and credit cash. This is the general journal entry prepared when the payment is made. Then at the end of the period, the company would prepare an adjusting entry to recognize the portion of the insurance that is used during the period. It would debit insurance expense to recognize the incurrence of an expense, and it would credit prepaid insurance to reduce the asset account because that portion is no longer prepaid. After the adjusting entry, the asset balance should be the amount that is still prepaid or unused at the end of the period. The expense should be the amount used during the period. If we didn't prepare the adjusting entry, the asset balance would be overstated and the expense balance would be understated, and therefore net income would be overstated. Now let's continue our example with Sierra Corporation. This is the trial balance for Sierra Corporation, which is where we left off in Chapter 3. We must now look through the trial balance to see which account balances are incorrect. Let's first look at supplies. Remember from Chapter 3 that Sierra purchased supplies costing $2,500 on October the 5th. When we journalized this transaction, we debited the asset account supplies. At the end of the period, the remaining supplies were counted, and it was determined that $1,000 of supplies were still on hand. This should be the ending balance in the supplies account because this is the amount that will still provide us benefit. The difference of $1,500 is the amount of supplies that we used during the period and should therefore be expensed. So, we need to record the incurrence of the expense and the reduction of the asset. We debit supplies expense and we credit supplies for $1,500. Now, the balances in supplies and supplies expense are correct. The next item that we need to look at is prepaid insurance. As you'll remember from Chapter 3, on October the 4th, Sierra paid $600 for a one-year insurance policy. When we journalized the transaction, we debited prepaid insurance and we credited cash. We debited prepaid insurance because this payment will benefit not just October, but the following 11 months. The question is, how much should we expense at the end of the period? When you are given a question like this, you should always calculate the per month expense. In this example, the per month expense is $600 divided by 12 months, or $50. This insurance policy costs Sierra Corporation $50 per month, and therefore its per month expense is $50. Because we are preparing financial statements for the month of October, we need to expense 1 month's worth of insurance. We have used up $50 worth of this insurance at the end of the month, so we need to expense that much. We would debit insurance expense for $50 and we would credit or reduce prepaid insurance by $50. After our adjusting entry, we are left with $550 in prepaid insurance. This represents the 11 months of insurance that will still provide benefit. We also have $50 in insurance expense, which represents the $50 of insurance that we used during the period. Now let's talk about a special type of deferral, which is depreciation. Fixed assets such as buildings and equipment are recorded as assets rather than expensed when purchased because they will benefit multiple periods. However, we must expense the cost of the assets except for land. We will expense a portion of the asset's cost over the time period that the company expects to use it, which is known as its useful life. We expense it through what's called depreciation. The entry to record depreciation is always a debit to depreciation expense and a credit to accumulated depreciation dash whatever it is you are depreciating. Remember from Chapter 2 that accumulated depreciation is included on the balance sheet in the fixed assets section, and it is netted against the associated asset. It is known as a contra asset account because it is in the assets section, but it reduces assets. We will learn how to calculate depreciation in later chapters. In Chapter 4, the number will be provided to you. Now let's look at the depreciation for Sierra Corporation. We are to assume that depreciation on office equipment is $480 per year. However, remember that we are preparing financial statements for only the month of October, so we only need to recognize 1 month's worth of depreciation. You would divide 480 by 12 months to get the per month amount of $40. We would debit depreciation expense and credit accumulated depreciation dash equipment for $40. The second type of deferral is unearned revenues. Remember, the company gets paid for something that it has not yet provided. When we receive the payment, we record a liability because we now have an obligation to perform. We must prepare an adjusting entry at the end of the period to record the portion earned during the period. The adjusting entry will always involve a debit or a decrease to a liability account to recognize the settlement of the obligation, and a credit or an increase to a revenue account to recognize the portion that is earned during the period. A common example is customers prepaying for service. When a company receives the payment, it would debit cash and credit unearned service revenue. This is the general journal entry prepared when the payment is received. Then, at the end of the period, the company would prepare an adjusting entry to recognize the portion of the service that is performed during the period. It would debit unearned service revenue to eliminate the liability, and it would credit service revenue to recognize the earning of the revenue. After the adjusting entry, the liability balance should be the amount that is still unearned at the end of the period. The revenue should be the amount earned during the period. If we didn't prepare the adjusting entry, the liability balance would be overstated, the revenue balance would be understated, and therefore net income would be understated. Let's continue our discussion of Sierra Corporation. Remember from Chapter 3, on October the 2nd, R. Knox, a client of Sierra's, prepaid for tour guide services. We debited cash and credited unearned service revenue. At the end of the period, an evaluation of services performed for R. Knox revealed that Sierra performed services worth $400. Therefore, the remaining $800 is still unearned. We should debit unearned service revenue by $400 to remove the portion earned during the period, and credit service revenue by $400 to recognize the earning of the revenue. After the adjusting entry, unearned service revenue has a balance of $800, which represents the portion that is still unearned. This completes Part 2 of the Chapter 4 lecture series on deferrals. We will now learn about accruals.